You're welcome to my channel. In this video we are going to be having a trial balance and an example. So a trial balance is a statement that lists all the ledger accounts of the business and their respective balances. It can be either a credit or a debit. And the importance of a trial balance is that it helps us to detect errors, to ensure accuracy. Then we also use it in the preparation of financial statements like the balance sheet, the statement of profit or loss, etc. Then it also helps us to identify discrepancies, because when the trial balance is not balancing, it means that there is an error somewhere. So it helps us to identify discrepancies. So we are going to be having an example on the trial balance. So the question says, prepare a trial balance for the following transactions of the year ending 31st December 2024 for Naisha Traders Limited. So first, business. These are the details, and we are going to be reading one by one as we are recording in our trial balance. So the formatting of the trial balance is this one. We have the column for details, then the debit, and then the credit. So the debit side usually has assets and expenses. So anything that has to do with assets and expenses is put on the debit side. Then the credit side, it has income, capital, and liabilities. That's what we put on the credit side of the trial balance. So this is our formatting. So we are going to be reading here one by one as we put in here. So they say the business received a cash payment of UGX 10 million from customers for services rendered. So they received 10 million for the services rendered, and that makes it cash. So cash is a current asset, so we debit it, which is 10 million, like that. Then the business has accounts receivables of 5 million. Accounts receivables are also current assets. So accounts receivables, they are current assets, so we debit. The amount is 5 million. Then the business owes accounts payables of 7 million to suppliers for goods purchased on credit. So accounts payables are current liabilities, so we debit it. So we write accounts payables, it is of 7 million, like that. Then the owner's capital investment into the business is 6 million. So that is capital. It is 6 million. So we said capital is also credited. So we put it on the credit side, which is 6 million. Then the business made sales of UGX 12 million during the year. So sales is income or revenue, and it is credited. So sales of 12 million, it is credited. Then rent expenses for the year amounted to 2 million. We said assets and expenses are debited. So rent is an expense, so we debit it. So rent, it is 2 million. Then the business has inventory worth 4 million at the year end. The business has inventory worth 4 million. So this is inventory, and inventory is an asset. It is a current asset, so we write it inventory. We remove this here end part. The business has inventory of 4 million. So that is 4 million. Then the business owns equipment valued at 8 million. So equipment is an asset, so we debit it 8 million. Then the business has a loan payable of 4 million. So loan is a liability, we credit it of 4 million. Yeah, so the details are over. So the next thing we do is to balance and see if the trail balance is balancing. As you hear it, trail balance, it's supposed to have the same figures on the debit side and then on the credit side. So on the debit side, we have 10M plus 5M plus 2M plus 4M plus 8M, which is 29 million. Then on the credit side, we have 7 million plus 6 million plus 12 million plus 4 million, which makes it 29 million. Yeah, so it is balancing, meaning everything is correct. And that is how we prepare the trail balance. All you should note is assets and expenses are debited, income, capital, and liabilities are credited. Thanks for watching. Do not forget to subscribe, like, comment, share with your friends. Let's catch up in my next video.